Private foundation is pretty awesome. Basically, you can set yourself up a 501c3 nonprofit. So just like donating to Red Cross Red Shield, except that it happens to be your own charity. And you could throw up to 30% of your income into this. And it doesn't have to be cash. Basically, your adjusted gross income, right? So you can donate vehicles, stocks, assets, whatever the case is. The foundation has to pay out 5% of the foundation value every year to a charity of your choice. We find that most clients are already donating. So you just donate, you do your charitable donations through your charity. And then the beautiful thing about the foundation is that, first of all, you can pull out a reasonable director's salary. So you can pay yourself at any time. It's very flexible with how this works. You don't have to pay yourself month after month. If you're going to go on a trip, you just pull some money out.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the real estate reality show at youtube.com/GowerCrowd. Welcome to today's episode. My guest today is Mark Swedberg, who is with Royal Legal Solutions. Now, I've known Royal Legal Solutions for, I've got to say, solidly 10 years and been in touch with them off and on throughout that time. But my conversation today is with Mark is part of the real estate tax investigation series that I'm putting together. And Mark has a particularly interesting angle to how to leverage, or I want to say understand the tax code in such a way that you derive significant benefits from your real estate activities. Now, he actually sent me a short video. I'm going to ask him if I can put it up on the page here. I don't know if it will be. Check at the podcast page at gowercrowd.com. See if I put it up there. He actually sent me a short intro video. But what I will tell you, whether or not it can go up on the website, if you'll let me share it with you, is that it included, let's see, 416 distinctly different ways that you may not have heard of that you can leverage to avoid taxes that you don't otherwise need to pay. And all of them, for the most part, are real estate related. So we're going to be talking about some of those today. It is a fascinating discussion. Subsequent to recording today's episode, I've actually spoken to several of my highly esteemed professional friends about some of the ideas that Mark talks about, and it warrants further investigation. Let me put it that way. I get the sense that if you do follow up with Mark and his team after you hear today's podcast, that they will be candid with you about the pros and cons of the ideas that they have. You should definitely look into them. It's worth doing, and as you will hear, as you learn from Mark today, he also suggests the best thing that you can do is do exactly what I've done. That is, talk to people you trust about his ideas and then come back to him and implement those that make sense for you. Okay, it's a very interesting show today. If you want to get links to Mark and Royal Legal Solutions, go to the gowercrowd.com website, find the podcast page. And while you're there, if you've not already subscribed to our newsletter, it goes out once a week, it's totally free, covers the world of real estate syndication and crowdfunding. Please sign up. You can always unsubscribe, and I'm sure you'll find it interesting. And we list everything that's going on in commercial real estate, as well as the highlights of some of these podcasts, actually all of the podcasts, week by week. As well as other high-value educational content, all there at gowercrowd.com. Right, enough. Let's move on to this fascinating discussion with Mark Swedberg. You're going to be learning about all kinds of ways to structure your life, your financial life, in ways likely you've never heard of before. Here he is, Mark Swedberg, Royal Legal Solutions. Mark, thanks so much for joining me today. Oh my goodness, I've known your company for, I think since inception, actually, because we both started up at around the same time. So it's a pleasure to have you on the call. And we are going to be talking about some very, very interesting tax strategies. as well as asset protection strategies for real estate investors, both passive and active. And you sent me this 15-item list. I've never seen anything like it. I've never got one like this from my accountant. I'll tell you that right now. That has a bunch of stuff that I already do and a bunch that I do not implement already. So the first one, I think the big interesting one is private found. Actually, why don't you start at the very you start. Tell me what it is that Royal Solutions does. First, Royal Legal Solutions does high level, and then dive into what is a private foundation and how can mortals actually set those up. Mortals meaning those who earn 150,000 and above, which doesn't seem like a big number for a foundation.
Awesome. Well, I'm so glad to be here. I love your podcast, and we've definitely worked with you. So it's been great to get on. Royal Legal, basically what we're doing is what you would call a fractionalized family office. And so if you were a billionaire or basically if you have over $250 million, you could have a family office, your own attorney, your own CPA, your own private financial advisor, get them to run everything for you. But most people can't afford that $250,000 per year cost. And so what can you do? You can do it yourself, or you can work with what we call a wealth building company, which is where you get all of our team, which is essentially a family office on a fractionalized basis. And we're going to help you get advanced secrets for both tax and legal strategies. And so that's kind of what we're aiming to do here. And then, you know, our job is to get you down to like 0 to 10% in tax, help you find ways to get 20 to 30% ROI, and set up lifetime estate planning and set up all of your entity structuring.
Right. So basically you've got in your basement there, you've got a little boiler room full of accountants and lawyers, right? Is that
something like that? Right. We're all remote at this point, you know, but
you've not got them chained to desks in a darkened room or anything.
Well, you know, last year they were chained in there, but they revolted, so we had to let them out.
Okay, so the big one on your list, and you articulated this, the most intriguing, the idea of setting up a private foundation. By the way, I know you've been very clear, you're not an accountant. So getting into that, and anybody listening, there's no advice going on here. This is just a kind of strictly educational. If you want advice, you're going to have to follow up with Mark directly and put you with some of his lawyers and accountants over there. But so high-level educational, private foundation. I've always thought of a foundation as being something that only billionaires have. So how does that work? What are they, and how do they work for, like say, mere mortals, those who are earning only 150,000 a year and above? And why not 100,000 or 75 for that matter?
Well, the ticket price on our Royal Elite package, when we combine everything into this fractionalized family office, it really, our goal is to help that pay for itself within really 2 years or a year or less. And so under 150,000, we normally just can't help you get the ROI that we want you to achieve. You could still do it, but normally at that point, a la carte kind of works. So
all right, so what's a private foundation, for heaven's sake?
Private foundation is pretty awesome. Basically, you can set yourself up a 501c3 nonprofit. So just like donating to Red Cross Red Shield, except that it happens to be your own charity. And you could throw up to 30% of your income into this. And it doesn't have to be cash. Basically, your adjusted gross income, right? So you can donate vehicles, stocks, assets, whatever the case is. The foundation has to pay out 5% of the foundation value every year to a charity of your choice. We find that most clients are already donating. So you just donate, you do your charitable donations through your charity. And then the beautiful thing about the foundation is that, first of all, you can pull out a reasonable director's salary. So you can pay yourself at any time. It's very flexible with how this works. You don't have to pay yourself month after month. If you're going to go on a trip, you just pull some money out. That will come at your regular tax bracket.
Income tax.
Correct. Whatever you're at. So if you're at 20% this year, then you would be paying 20% on that. We treat this more like a private pension fund. So when you're in a high income bracket, what you want to do is you want to fund this thing up, whatever reasonable level is to hit your financial freedom goal. Whatever number of passive income that you need to live, say you want to live at $200,000 a year, we would take a look at that and say, all right, how do we get you at $200,000 a year in passive income? the private foundation may contribute to 50% of that or 100% of that strategy, right? Out of all the tax strategies that we do. We want that thing to be funded in perpetually funded. And that way it'll just constantly kick out whatever director's salary that you need. And so the private pension fund, you fund it, you build that thing, and then you can pull out your wage once you retire, or once you're in a lower tax bracket.
Well, hang on a sec. So use the term private pension fund. Let's stick with the same term. With that, you're using that synonymously with private foundation.
It's kind of the way we view it. It's not a pension fund, but you're treating it as if
A pension.
you're building your own pension. Right?
Okay, I understand. It's just again, just so that we are using the same nomenclature throughout this.
Correct.
Talk about private foundation. So that is,
it's a 501c3 nonprofit private foundation as opposed to a 501c3 public charity.
Okay, so private foundation. So that is the term that the code uses.
Right.
Okay. Presumably you don't have to take a salary out. You can take a salary out anytime you like. And also presumably the foundation can, so if you don't take a salary out, it's what the cash available inside the foundation just grows year on year. Presumably you can invest that. Are there any limitations on how you can invest that or what you do within the foundation versus paying yourself a salary if you're not paying yourself a salary?
It's extremely flexible. I mean, this is the best investment vehicle out there, really, in our opinion. Definitely one of them. You can invest in assets. You can buy vehicles. You can do all kinds of different things with this foundation. It's really a charity. So you think about Red Cross, Red Shield, or these other charities. I mean, they may buy buildings. They may send people out on trips. They might do all kinds of different stuff as part of the function of that charity. And so, you have a lot of flexibility with this. One of the beautiful things about the private foundation is that you're also not paying capital gains on the investments in there. You have an excise tax, which is around, say, 2%, a little bit under 2% right now. But that means that if you invest in syndications or whatever, you can realize huge gains because that capital gains tax isn't present. And so it makes it extremely efficient.
Right. So the foundation goes out and buys a building and sells it at a profit. There's no tax due on that. Is that right?
You're going to have an excise tax,
Small,
right? But
so whatever it is, 2%, but not the
very low. Right. It's not going to be a massive capital gains bill that you're paying.
So what is the services intent for these foundations? I mean, what are they hoping they will be used for? Why is it there, even if it's such an easy win for consumers?
Well, I mean,
yeah.
Right. I mean, you've got to wonder why they have these loopholes in there. I wouldn't really say loopholes. I mean, it's just the way it's designed. It's really, in one sense, you could say that it's designed to contribute, to help. If you're truly trying to, say, go to a third world nation and build structures for people and provide healthcare, you actually want a vehicle that's going to be really efficient at that, and you want to be incentivized to do that kind of work. And so you can just see the really powerful incentives that they're putting into this type of a structure.
Is there a limit to how much salary you could take out? Let's say you contributed, for argument's sake, 50,000 a year for 10,000. Sorry, for 50,000 a year for 10 years, and so you got 500,000, assuming you didn't do any investments. Could you take a $500,000 salary in year 11?
It's going to have to be what would be called a reasonable wage or a reasonable salary. There's some IRS benchmarks on that. That's going to vary on a lot of different things, partly like the foundation's value. But those are very flexible as well. So there's going to be a big range. It's just, if you're running a $500,000 foundation and you pull out $350,000 in 1 year, it's probably not going to make a lot of sense. When you just look at it, you're going to be like, what? You took over 50% of your value out of the company in 1 year as a salary? I'm not quite sure about that. So one of the things that we do with our clients is that we'll take a look at, like I said, that financial freedom number, your passive income. If you're wanting to pull out $200,000 a year in retirement and live off that amount of money, we need to know how much money needs to be in that foundation to um, get the ROI to fund it, and actually be able to pay you the salary and pay that 5% foundation value out each year to charities.
Right. Yes, and that has to come out of there.
Right.
Okay, so it's probably too much for this, because it includes our conversation, I think, actually includes a lot of mental arithmetic as well. It
There's a
makes it,
lot of math. Yeah.
yes, and it's almost as though what I'd like to do is sit down and, in fact, I know that it is possible with you sit down and have a consultation. It is a paid consultation. Sounds like it's very, very well worthwhile for anybody listening. But it would involve sitting down with an Excel spreadsheet and probably a rocket scientist, because there is also, so what you're basically doing, sorry to kind of get into the weeds here a little bit, but what you're basically doing is you are converting capital gains level tax into income tax. So this is why it's something I'm kind of, my brain isn't quite capable of handling all in one go. But basically, if you put money in, you're saving income tax. Actually, you're saving income tax when you go in, right? That's the point. You save income tax when you go in, and then you can grow whatever's gone in that would grow at capital gains tax, but then it comes out as income tax, right? But right, so how does that actually all work? It would be good to kind of create a scenario. He said, talking out loud in his own mind. But presumably you can use the assets that the foundation owns. So if the foundation owns a car, you could use that car, but you wouldn't be able to do any deductions for that car because it's the foundation that owns it. So you're pushing it all off into the foundation, right? So you would lose that deduction on your regular income.
Correct. When you transfer an asset in of any kind, vehicle, property, whatever, now that foundation owns that asset. And so then that asset gets all of the benefits of the foundation, but you can't just like pull that out. The foundation could sell the asset, increase the liquid cash inside of the foundation. That could then come out as a director's salary that you would pay at your income tax rate, your regular tax rate. But that's how that would work. You can't just pull the assets in and out.
Okay, so now this is where the devil is in the details. And again, just stop me if we're getting too weedy here. Or too into the weeds is what I mean. But so I donate, let's say I've got a $50,000 car and I donate that 100,000, I don't know, whatever world you live in. Let's just say a $50,000 car. You donate it to the foundation. Now the foundation owns it. You have a deduction because the value of that car was 50,000 when you donated it to the foundation. So you show that as a 50,000. There's a limit on how much you can donate of your own income. So within those parameters as well.
Right.
But assuming that it's within that limit and you're not exceeding that limit. So you make that, and now you run around town driving it. Is that considered some kind of income to you that in lieu of drawing a salary, for example? Hey, you got the benefits of this car now, so we're going to assign some level of value to that running around in that car. We're going to impute income from that.
No, there may be some requirements on is the car being used in line with that purpose. But the other thing about this is when you set this up, you're going to have to choose a charitable cause. And these causes can be extremely broad. And so what you're able to do is kind of structure your cause in a way where that car, the use of the car could actually fall in line with your regular activities, more or less.
Okay. All right. So that is definitely deep into the weeds, and that's something to talk about.
Get a little into the weeds. I mean, that's why you sit down with attorneys and CPAs, and they're going to go through all the nuances.
Right. And as you've told me before we started, you have a fee-based program for getting people to go through that with attorneys and accountants on your side. I remember once, I think I've said this on one of these tax podcasts or masterclasses that we're doing, that I had an accountant one time that said, and it's never gone away in my mind, said to me, yes, that you have this benefits if you do that, but then this happens. He said, what the IRS giveth, the IRS always taketh away, is what he said. So, there's no free lunch. There's always something, right? That's kind of what I'm drilling down on a bit here.
Right. It's like a big maze of rules, and that's why you want to sit with someone that's extremely high level in these categories, because they're going to actually show you how to get through that maze. A maze always has the potential to get through it, but are you going to be able to do it running blindfolded through the maze? No, you're going to be bouncing off walls all day long. So you want to actually talk to someone that knows how to get through the maze.
Yeah,
And that's what we can help with.
well, this is, use the term maze. It's an interesting analogy. I think of it more like a labyrinth. Once you go into a labyrinth, you never come out. There is
Well,
no
we
way
know,
out of the labyrinth.
right. We know people are coming out because if you look at billionaires, you look at these high income guys, how are they paying no tax? They know how to come out of the maze. So you can actually do that too. There is a way to do this.
Mm. All right. Is there anything else you want to tell me about the private foundation? Sounds fascinating. Anything else kind of high level, wide, just thoughts, but maybe
Yeah.
missteps that people can make going to, privatefoundation.com and setting their own up or whatever you can do.
Oh, well, I mean, so I've personally actually set up my own 501c3 nonprofit before. It's a pain in the butt. You got to write bylaws. There's all kinds of nuances. So doing it yourself, of course, you can always do any of this stuff on your own. It's just how much work do you want to do? The point behind Royal Elite is that you're getting access to really high level strategy. So the private foundation is just one tax strategy out of, say, we've got like 25. And what happens is you actually layer all of these tax strategies to get the optimal benefits. Both, we're talking about getting through that maze again, right? The private foundation is a beautiful tool because you don't have to put any money into it until the very end of the year. And so what we like to do is we'll actually set you up with other tax strategies first, see what we can save, see what additional liability that you have right towards the end of the year. And then whatever else you have, you can throw some money into the private foundation to offset that. So it's extremely flexible in terms of kind of saving the day at the very end. The last day of the year, you can wipe out that remaining whatever tax you have.
Right. I have to tell you that I don't want to sound too negative, but it's like too good to be true. That's why I told you before we started. It's like I want to talk to some friends about this. Do you
I
get
gotta
people
say,
reacting that way, like often?
it's in our sales script. That phrase, both of those phrases, it's too good to be true. We actually have that in the slide deck. It's too good to be true. I got to talk to someone about this. Because what you're going to find is most people are extremely conservative. Actually, I was just talking to an asset protection attorney who was on our call the other day, and a tax law attorney, and he was asking us, I got to talk to you guys about this stuff. My team says I can't do this. And then he told me that, what I hear from his CPAs, it's like either they're too young and they're kind of unseasoned, they don't know the tricks, or they're kind of getting old and they think they know everything in the game and they're not actually open-minded to these different strategies. And so you actually have to find that middle ground. What we do is we provide the middle ground. And if you start talking to people, what you're going to want to look for is, don't ask them, do you recommend this? Because they may be uncomfortable with it on a personal level for whatever reason. Ask them, is it possible? Is this breaking laws? Talk to them about the actual hard details. And what you're going to find is that this is totally within the law. This is a completely legitimate way to use it. It's just people are uncomfortable with any kind of risk. When you're dealing with lawyers, doctors, dentists, attorneys, CPAs, right? They're extremely risk averse. They don't want to get sued. So you've got to factor that into the consideration you're making when you're talking to other providers.
Okay, so what are the downsides of using a private foundation? Presumably there are some. What are the kind of missteps not missteps, but what are the surprises, perhaps is the right term, that folk have stumbled across or that you've discovered using them? What is the downside, I suppose?
It's going to come down to, for me personally, the big downside is, how do you like to run your life? Do you want your assets and your money inside of a separate vehicle where you can't, I can't pull that car back out once I donate it in? I'm the kind of guy, I like to run a lot of active businesses. I like to put my money in active businesses. So tax shelters for me, I feel like I'm getting a little bit handcuffed. I don't like that. Now, that said, that's my preference. I'm an entrepreneur, so I want to push my money into active business, and I take business losses and I do other things to offset my income. This is going to be very strategy and personality specific. What is your lifestyle, and what do you want to do to reach that lifestyle? What tax strategies are actually going to fit into your personality? When we walk people through a tax strategy session, typically we're going to show you like 3 to 5 strategies that are going to have a pretty big impact, say 5,000, 10,000, 50,000, sometimes, depending on your income. So there's going to be 3 to 5 strategies, and a lot of people will move forward with 2 to 3 that are like, oh, these really fit what I'm looking for. And so it's really a matter of preference. Does this fit into the lifestyle that you want to have?
Really interesting. Okay, and that's the kind of conversation that you have in these initial consultations, isn't it, Mark?
Correct,
Right?
because if you're choosing a private foundation or a solo 401k or a Augusta rule or the short-term rental, all of these have their own nuances to them. Like you said, we get down in the weeds. There's calculators for all of these things. There's specific rules and thresholds. And so you actually need to be informed about how all of these work so that you can make a decision like, this one rule about the solo 401k actually means it's kind of a deal breaker for me. And I didn't know that till I sat in this meeting, but now that I see that, it's not going to work. But then you're with the CPA and we can just game plan right there and say, well, actually, how about this strategy? So that's the benefit of it.
Okay, we're only going to go through a few of these today. By the way, we started on time, and then we talked for half an hour. So we've been talking for half an hour now. How much time do you have? We're coming up to the top of it.
I'm pretty good. I got 15 minutes after.
Okay, so let's keep going because I do have some more questions. So you sent me very kindly a very cool Loom video. For anyone that's not used Loom, to explain yourself before meetings, just to get ahead of the curve, look it up. LOOM.com. It's the most amazing thing. Thank you for doing that.
I love it.
And one of the slides included 15 different tax saving strategies. We're going to look at a couple more of them now. But before we do that, do any of them cancel out others? In other words, if you've got a 401k, does that mean you cannot have a private foundation or etc.? Are there any that, if you do one, it precludes you from using another, or can you use all of them?
I don't think there's any like harsh cancellations that I'm aware of. But for example, say the qualified business income deduction, where you can you can deduct 20% of your income. Like that would be offset by, say, a depreciation and a private foundation strategy, in the sense that if we can get you to have no income, it's just a useless strategy. Right. So they will offset in certain ways. But
okay, but it's not like there's
no thing that says, oh, if you have an IRA, you can't have a 401k. You can have both of them.
You can, but you are limited on how much you can pull out.
Each of those will have their own limits, correct?
Well, they have their own limits, but there's also a cap on how much you can deduct and put into those anyway, right? Each year,
correct.
Like in the aggregate, it's not one after the other. They don't add up. There's actually a limit, I think, to in the aggregate, how much. So if you've got a 401k that you're putting as maxing out into, you can't put something into an IRA as well.
You can put stuff into like a self-directed IRA. Now there's going to be an interplay between a lot of this stuff. So the interplay would be, and actually there's a bigger interplay too, which is not just all of the tax strategies, but then also layering in your investments on top of it. All of these, and then also the legal strategy, the types of entities that you have on the legal side, the types of investments that you make, and the types of tax strategies all have an interplay. And there's this is again where we get to the maze analogy. There's a way to put all of these together where they're rowing in the same direction, where they're all streamlined, and you're able to max these out. And you need to know the nuances behind each of these to really navigate that correctly.
Right. And this is what you guys advise on, isn't it?
Correct. And that's why, when you're talking to me, you're getting a very high level overview here. You actually need to talk to specialists that have been trained in this stuff to kind of guide you through those different paths.
Okay, right, which is exactly what I'm going to be doing. So watch this space. And if I go silent, then whatever. But I might just well talk about this a little bit more later. All right, so let's take a look at some of these others off this 15-point list. The other one that you talked about, I think you and I discussed this. So hang about. This one was a good one. The Augusta rule, but this was named after the golf tournament.
Right.
All right, it actually originated because people they were doing something with their homes in Augusta for I forget what's the Augusta rule? Actually, this would be a good one to talk out of the 15. We didn't actually cover all of them that we were going to pick up, but this is a good one, right?
Yeah, this is a fun one. So the Augusta rule, you can basically rent your primary residence, your home, to yourself, or really to your own business. So, for example, I have an S corporation. I have an LLC with an S corporation delegation, and then I rented my primary residence to my business for business meetings. I chose, I looked in my local area. I saw what the peak Airbnb rental ranges were for each season. Then I just chose a couple dates each quarter. I ran a meeting in my house. I took my meeting notes, and then I was actually able to have that LLC pay me to rent my house, and that then comes in as tax-free. So I basically just siphoned off money.
Well, actually, what you're doing is you are not only are you gaining income tax free, but you are also getting a deduction, aren't you?
Correct.
The company's paying you, so you got a deduction and you've got the income. So it's like a double whammy.
Right. Yeah, I'm dropping my business revenue, so that's lowering my tax bracket potentially, or getting me closer to lowering that tax bracket. Then in addition, I'm getting free income to my personal. So
That's a wacky one.
it's great, and it's pretty easy to do. You spend. I mean, I think it took me less than an hour to kind of just run all the numbers. It's just, if you know the steps, not that hard. You do have to have an LLC in place, though. You can't just rent it to yourself. So,
Okay, again, something that you help set up and get going and etc. Right, so what are the others here? Do we want to talk about the STR loophole? That's only this it's Airbnb, but it stands for I keep forgetting.
short-term rentals.
Short-term rental.
Yep. So you might be on Airbnb. You might be on some other site, though, like a VRBO or something too, right?
Yeah, that's why it's not the Airbnb, but the short-term rental loophole suggests that you must have a short-term rental in order to
Correct.
benefit from that. So you got to go out and buy a house. But just in case you do, how does that work?
Well, that basically then allows you, once you have that short-term rental, you can do a cost segregation study, and that's going to allow you to offset your income through depreciation. So that's basically how it works. Is just giving you some bonus of depreciation on your rental.
Right, and that's again, we are getting very much into the weeds again, but that is offset only passive income, not income that you might earn if you're a doctor. You can't deduct it from your salary, for example.
Right.
It's just off the income that you're
It's
getting
from
from
it'll
the
actually
property.
offset your active income.
It will.
Yeah, that's what the CPA. I talked to my CPA about this one. He said it was active income.
Interesting. Okay, the STR short-term rental loophole. But you got to have a rental that you're renting out to somebody.
Well, yeah, you got to have the property in place, and you have to qualify for the short-term rental loophole. There's 10 different ways to qualify. The most common are going to be that you would need to work there 100 hours more than anybody else. You'd have to put in at least 300 hours total, or you could be the one that makes management decisions, which is probably going to be the easier threshold, unless you're in some kind of a joint situation.
Right. But if you buy one, if you're what do you call it? If you're the principal I forget the term, there's a term for it. But if anyway, you're the head of the house, right? And you go out and buy one and you're just running it like a rental down the road. that's the management control over it. I mean, it's not like a kind of corporate level kind of thing, right?
Correct. There's gonna be some criteria about what does a management decision actually look like, and as long as you can prove that. So
Yeah.
the three that I listed, those are the most common ways we get people to qualify. But
Yeah.
like I said, there's 10 ways. There's a bunch of different options for this.
Yeah. And I would note that as soon as you start talking about the number of hours that you have to
A little
apply,
scary.
well, it's not just scary, but it also has to be extremely well documented. You can't kind of make it up retroactively. It's, oh my goodness, I'm being audited. Quick, I'm going to put stuff to. You got to document it. So I know that that's important to keep your nose clean. Which others? We're running out. What are the others that you wanted to cover from that 15-point list? We've got paying family is
Yep.
one of them. Yeah.
So paying family is a fun one. Again, pretty easy. So you would have your, say I've got an S corporation. I have my kids come and do some work for me. And so what you don't want to do is you don't want to pay them over the standard deduction threshold. What you're really trying to do is you're trying to pay them right up to that point so that they're not paying taxes on it.
Ah.
And then you also get to offset that business income, just like the Augusta rule. You're dropping your business revenue. And so that's the way to kind of keep the money in the family. The kids could do basic stuff, right? They could do yard work at the rentals or post on social media or whatever the case is. It's got to be, the kids have to have a reasonable salary and be doing reasonable work is the main criteria here.
And you told me not to ask you this, but I'm going to ask anyway. Standard deduction limit, like what is that kind of annually, approximately? What does that look like? How much?
I believe it's 13,500. Don't quote me on that.
Okay, fine.
I don't know
So,
at the
so
top of my
around
head.
$1,000, a little over $1,000 a month, basically.
Right. And
And
then
that,
that's potentially 13,000 you're pulling out of your active income. Or if you have multiple kids, like you can really drop your the pass-through
right, but they
income.
also have to be of age as well, presumably. You can't put
Uh,
your 3-year-old to work.
a 3-year-old, I mean, what are they
Cleaning
gonna?
chimneys, maybe. I mean, if you get them cleaning chimneys, it's okay, but
Right. Yeah.
no,
Now
I'm
I think.
joking.
Well, yeah, you don't.
I'm
Nobody's
thinking
gonna
of
buy the
Victorian
3-year-old did
England.
anything.
Send them out to work, little buggers. Right, down the mines for you. It's what I used to tell my kids. If you don't do
Right.
your homework, it's down the mines for you.
Yeah.
But okay, so they presumably there are some limitations on that, but you can hire. It's a deduction, and you keep the money in the family. That's basically the idea there.
Correct. Yep. So if you're already paying your kids for something, you might as well do it this way, and then you're offsetting the tax.
So you don't have to, because it's your kid, then you wouldn't have to 1099 them. You wouldn't have to get a W-9 and then send them it's a 1099, right, at the end of the year, which is over $600 a pay to anybody.
They're still going to have to. I wonder about that. I actually don't know this one, but even if you do, as long as you're under that standard deduction, they're not going to owe taxes. Is the primary point. They may still have to file the tax return, but they're
But
not going
nothing
to
would
end
be
up
owed.
paying tax. Like if
I
they
see.
end up having to pay tax, you're kind of defeating the point then.
Right. So if they have another job, then it's kind of makes no sense, right? If they're flipping
Yeah,
burgers
potentially.
somewhere and making $1,000 a month, it kind of wipes out the benefit.
Right. And then again, that's where we get into the kind of the nuance with the CPA where they can kind of help guide you through like what is the correct limits and how should you do this and can my 3-year-old work on my renovate my kitchen?
Paint the
Probably
house.
not. Right.
Exactly.
Probably not.
All right. So of this 15 list of 15, what others are your favorites? We're running out of time. And first I said, let's go through all of them. There's no way. What would be your faves? I know you had a good chat with your team, and thank you for doing that before we came on.
Right. Well, I mean, so I love the private foundation. I use the Augusta rule. I love bonus depreciation through syndications. Those tend to be the ones that I've used to get my tax rate down to 0 or very close to 0% over the past couple of years.
Okay.
Those are going to be my favorite. A lot of people really like S corporations. I love S corporations. The solo 401k gets used quite a bit. I'm less familiar with that, again, because I don't really like my money tied up in a vehicle or a tax shelter like that. But I know solo 401ks come quite a bit into use.
And then, of course, listen, as we run out of time, asset protection strategies. We mustn't forget that. It's part of
Yeah.
your elite package. What is all that about?
Well, it's entity structuring to prevent, basically to keep you safe from lawsuits. And a lot of people come in that are W-2 earners and they're like, I'm not going to get sued. I don't have to worry about this. But the reality is, anybody can sue you at any time for any reason. So if you've got a jealous neighbor that sees your house or your nice cars, if you get into a car accident, if you have some kind of a dispute, you're always opening yourself to liability, and you're just assuming that nothing's going to happen. So what we do is we can guide you through, and then of course, if you're in an active business or a medical practitioner or doing real estate, then you're really in kind of the hot seat at that point. So what we do is we kind of take a look at your situation and can set up the appropriate level of asset protection, whether that's setting up just like a single LLC. The other benefit of, say, like a regular LLC is that a lot of these tax vehicles tie into that LLC. So the second you get an LLC, you can then get into that S corporation tax strategy. You can get into a self-directed IRA or a solo 401k, maybe a defined benefit plan. There's a bunch of additional things that happen when you add entities into the mix. Like I said, the tax, the entities, and the investments, they all intermingle. They all have an impact on each other. It's not like you're just doing one thing. They all have an interplay. And so we're looking at the full scope. When somebody comes in and says, hey, I want to save money on tax, we might say, well, does your spouse work full time or they stay at home? If they're stay at home, actually, you might be able to qualify for real estate professional status. We might ask you, do you have an LLC? If not, maybe we should set one up, because that'll open up 2, 3, 4 different strategies for you. So we're kind of looking on the asset protection side, we're looking to protect you, but we're also looking to see what kind of strategies this opens up.
Yeah, I tell you, it's fascinating. And the only way to really understand this is to have a proper conversation with you and your team. My eyes are spinning, and so is my head. For anyone not watching, they really are rotating like the cartoons. So really, how does somebody who is at the very least intrigued to know more about what you're doing, I can't imagine anyone who wouldn't be, how do they reach you? What's the best way of connecting, maybe learning a bit more before taking the leap to one of those fee-based initial consultations?
Right. So we use like a very low pressure process. We love education. We love talking to people. The best way is just go to royallegalsolutions.com. There's going to be some videos on that page and client case studies that you can go through. There'll be an option to get into our vault, which has hundreds of videos, a free chat with attorneys and CPAs, so you can get into that and do your own research. It's got a free course. And then, of course, it's got a form on that page. If you do want to take a look at getting into a conversation with us, just fill out the form. We're going to ask you some basic questions so that we understand your situation, and then we'll put you with the right person, whether that's a CPA, an attorney, or whatever the case is.
I've known you guys for 10 years, and I can't help that I've been spending the last 10 years with my eyes wide shut. So thank you for setting me up with one of these initial consultations.
I'm excited.
I'm definitely going to take you up on that. I'm extremely interested. I am going to ask some trusted friends, and then let's talk again. I know you would prefer that I do that, I'm sure.
Of course.
Yes. So thank you. What an enormous pleasure, Mark, to meet you today. Thanks so much for appearing and joining me today on the show.
It's been fun. Thank you for having me.
All right, that was Mark Swedberg of Royal Legal Solutions, describing some very interesting tools, tactics, strategies, techniques, I don't know what you want to call it. But anyway, ways of structuring your financial world to avoid paying taxes that you don't need to pay, right? That's kind of the point. It's a distinction, right? Isn't it? The avoid paying taxes that you don't need to pay versus evading them, which is illegal. But avoiding them is absolutely legal, and you certainly shouldn't be paying more than you should. All right. So what can I say? Mark, thank you for joining me today. Really fascinating. I am recording this introduction sometime after we spoke, and I have spent a lot of time and continue to spend time talking to knowledgeable friends and trusted professionals in my world. Very interesting what you've got. I really appreciate you introducing me to them, introducing everybody who's listened to the show today also to these ideas. They definitely warrant digging deeper and employing those, exactly as you said, that make sense, and disregarding those that do not. And thank you too, dear viewer singular, for joining me today and joining Mark. Really appreciate you taking the time. I hope you found it as interesting as I did. This was probably one of the most, definitely one of the most interesting podcasts that I have recorded for a long time. And so I'm grateful to Mark. I'm grateful to you also for having listened in. And like I say, I hope you found it as interesting as I did. All right, that's enough for today. This is Adam Gower. See you next time. This is Adam Gower signing off.